Welcome, everyone, to the Nichols Tax Update Podcast, issue 21-01, the first issue of the new year, and it's a short week. This program is produced to provide current information about developments in United States tax law, cases, rulings, IRS pronouncements, and expert comments on hot topics. You are receiving it as a member benefit from the South Carolina Association of CPAs. My commentary is necessarily brief, and you should consult appropriate authority before taking a position on any item discussed in the program. I acknowledge the value here of my subscription to Tax Notes Today, a publication of tax analysts, the preeminent source of information for tax professionals as I prepared this program. Let's see what we've got. 4 items this week. Final regulations on small business accounting regulations, small being defined as anything under 25 million in gross receipts. That would have been virtually all of my practice for almost 50 years, but okay, small. Disclosures to avoid the accuracy-related penalty that protect the client and you, the preparer. A sports team loses its tax exemption, and a do-good organization loses its exemption as well, in spite of the fact that it really was doing good. Let's see how all that works. The small business accounting method regulations, preliminary, although they were finalized within 48 hours on 12/23/2020, simplify application of rules to apply Internal Revenue Code sections 263 Cap A, 448, 460, and 471 to calculate taxable income of an entity with less than 25 million in average annual gross receipts from a trade or business over the last 3 years. For example, direct labor costs are excluded from costs required to be included in inventory that is treated as non-incidental materials and supplies. Similar simplifications are made in the calculation of construction costs in process. I call it concessions applied to costs required to be capitalized under Code Section 460. I forgot that I had a slide 2 of 2 here. All right, well, we'll try to get on the ball. After all, it's the first program of the new year, right? A consistency rule requires a taxpayer with an applicable financial statement, an AFS, and an accounting year that differs from its tax year to consistently apply a mismatched reportable period method of accounting for its Code Section 471C inventory, the direct costs used for income recognition purposes. So yes, you can have one method for financial purposes and another method for tax return purposes. They can be mismatched as long as you're consistent. Consistently mismatched. Maybe it makes sense to the Internal Revenue Service. Doesn't make a lot of sense to me, but let's move on. Accuracy-related penalty guidance. This is an annual publication. Revenue Procedure 2020-54 continues a tradition of telling us when disclosure on an income tax return regarding an item or position will be adequate for the purpose of reducing or eliminating the understatement of income tax penalty under Section 6662D and avoiding the tax return preparer penalty under Section 6694A. There are no substantive changes from the prior year. It's very easy. Follow all the instructions for preparation of the return and disclosures that are required for proper compliance. And when in doubt, disclose on a Form 8275. Now, no amount of disclosure will protect a ridiculous position. You can't disclose your way out of a jackpot. But disclosure is necessary if the best you can do is a reasonable basis for a return position. I recommend, by the way, that you look at the AICPA Statements on Standards for Tax Services, Interpretation 1-2 for this purpose, to get some insight into the levels of disclosure where we might think of levels of disclosure. There's other guidance in Internal Revenue Service publications, but the AICPA guidance is helpful. You might also take a look at Circular 230, paragraph 10.34, has considerably consider a good paragraph, considerably long paragraph, on what disclosure is required and what a reasonable position is. Now we've got two exempt statuses revoked. The first is a 501c3. Here, the organization fails to show it was organized and operated exclusively for exempt purposes and that no part of its net earnings inured to the benefit of private shareholders or individuals. It was a sports club organized by private persons for the purpose of encouraging young women to develop their skills in field hockey. They would participate in tournaments and perchance might get recruited for a field hockey scholarship in some of the eastern universities where the women play field hockey. That doesn't happen so much in the West. The women out in the West just play football with the guys. Anyway, this sports club, each member had an account which is credited with their fundraising or their contributions. The member account was necessary to pay the expenses of a member's travel to tournaments, to pay entry fees for the member, and other expenses directly for that member. So the members benefited. Now let's go back. No part of its net earnings inured to the benefit of private shareholders or individuals. That simply wasn't true. It may have been organized with all kinds of high-minded purposes, but it was not operated exclusively for exempt purposes. And you have to meet both the organization test and the operational test. Both of those. I'm holding up two fingers. How do I get, there, I get two fingers in front of the camera. We're going to make this work. It's a new year. I'll sort this out. Now a 501c7 exemption is lost. Here, the organization never filed a Form 1023 or a Form 1024, and that, by the way, is not really necessary. They were organized as a not-for-profit corporation in their jurisdiction. It was a social club. Unfortunately, it received most of its income from rental of a building, which was its monthly meeting place, and from other investment sources. It had been quite successful in attracting investment sources and earning investment income. But here's the whole story. It helped establish the first high school in the area where it was. It established scholarships, and it helped worthy individuals who were deemed to be worthy by a process that was perfectly acceptable to the Internal Revenue Service. They had no problem with any of that. The problem was it had too much unrelated business taxable income from the operation of this building and other investment sources. So while there was no private inurement, it just had too much unrelated business taxable income, even though its purposes, what it did with the money, was perfectly legitimate and totally in line with the concept of a 501c3. In fact, the IRS observed in its letter denying the exemption that this organization actually operated as two. It could be bifurcated into a 501c3 and a 501c7. Perhaps they'll take the IRS's suggestion and finally file a Form 1023 and somehow manage to salvage their good work, their worthy endeavors in the location where they existed. Well, as I said at the outset, it's a short program this week, so take advantage of it. Use the time for something worthwhile. And until next time, please stay safe.